So currently now we are recording transaction on your general journal from journals, from to your general ledger from what? Journals. So we say that each and every of your journal is created from what? The double entry system. So we still follow the same principle. But the principle for the ledgers is that the account that is debited, you will go to the debit side of that account and record on the debit side. But you will write the name of the account that is credited, which is called cross-referencing, to indicate that the reason this account is increasing is because of this other account. The reason this other account is decreasing is because of this other account. So for expenses, it will be indicating whether these expenses were paid for using business bank account or using cash, or we received them on credit, meaning that it will say what? Business creditor. For those that you are receiving cash, it will be indicating on your business bank account that you are receiving cash because of this particular what? Transaction. So for now, for these learning purposes, you will be required to know everything I'm going to explain here. Then later on, we're going to expand using the same ledgers from only this learning unit. You will learn how you will be required to understand how to prepare your accounting equation, your journals, your ledger, your trial balance, your statement of financial position. But going forward, we will no longer be using those journals and accounting equation. We'll be using what? Only ledgers. So this is where you need to make sure that you master and understand this concept for further what? For further development. So let's start with the capital. So before you start by recording any transaction that occurred throughout the month, you start by writing down all the opening balances that you carried or that you are bringing down from the previous month. So for your capital account, we had an opening balance of how much? 350. Capital account is an owner's equity account, which means that it increased on the credit side. So the opening balance will be on the what? Credit side. So this means that this side, you're going to come and indicate 350 as your opening balance. Business bank, it's an asset account. If it says favorable, you have a debit balance. If it says unfavorable, you have a credit balance. It means that the business is at an overdraft. So over here, you have got your business bank, the opening balance, 143,000. Then we have got equipments with an opening balance of 126,000. This is an asset, so it will have an opening balance on the debit side. This is where your understanding of account classification comes in handy to identify whether the opening balance is on the debit or on the credit side. It all depends on the classification of the account. If the account is an assets, expense, or drawings, debit. If the asset account is an income, liability, or capital, that's your credit side. That's where the dead click, that's where we use the dead click. Everyone sign the register. Okay. Can just keep it over there. So law library, it's an asset. So we have got 425,000. Fees, let's go and look for fees. Fees account, it's an income account on our securities. That's a credit side, 845,000. Business client or debtor, Salis no. Okay, Salis no. So that's 45,000. Business client Julie Job. Here we have him over here, 38,000. ABC creditors, it's a creditor, so that's a credit balance. So ABC stationers, not, so that's 25,000 that we owe them. VAT input, we have an opening balance of 35,000. So we go to the VAT input on the debit side, 35,000. This is always having a debit balance. VAT output always a credit balance because it is always what? Credited. So we're going to have 92,000. Salaries and wages that we have paid. So these are expenses that we have paid so far. So you have got salaries and wages that we have paid so far, 98,000. So this is an expense, 398,000. Stationery that we have paid for so far, 46,000. Rent expense, 56,000. So that's 56,000. And then we jump over to your trust books. On your trust book, your trust bank have an opening balance of 83,000. Of which 55,000 belongs to Sally Snow. So meaning that Sally Snow will start with a credit balance of how much? 55,000. And the other balance belong to Toby Taylor, 28,000. So this means that now you have got all of your opening balance recorded. So what is left for us now to do is to go and total our journals. Once the journals are totaled, we can then start transferring some of the totals and items to your ledger's account. So going back, and these books are totaled at the end of the month. If you believe that you are still going to do reconciliation on the last day of the month, you keep the books open. The moment you write the total, this book is closed. You can no longer make an adjustment on these books. This means that all the adjustments are going to be made in what? In your, what we call in your supplementary, which is just a temporary cash book account or your journals account. So over here, what is our total receipts? So 134,990. Business debtor, 21,900, 990. Sundries, 113,000. So you're gonna do this for all the books. 20,000, 14,000, 2,500, 506, plus 127,000, 164,006. So I'm just gonna do only the totals for the mains account that we're gonna need. I think that sums up everything for the totals that we're gonna need. So you're gonna do, but for all of the accounts, for all columns. So let's start posting to ledger's account. We have our opening balance recorded in our ledger account. So our first ledger account is the capital account. So for this capital account, we do not have any transaction affecting it. We just have what? Drawings. So on your memorandum, they recorded on the capital account. So you'll have capital account being affected. So in our side, we are saying that we do not have these account. So this is what I'm just going to do, just to make sure that we have a record. So this means that we're going to refer to this one as drawings. So when did the drawing occur? On the 1st of, was it June? And then what did the owner took as drawings? Cash. So remember on your accounting equation, you said debited what? Drawings credited what? Business bank. So this means that we come to this account on the debit side and record on the debit side because this is the account that was debited. But under details, we write the name of the other account that the owner took what? Money from the business bank, which is the other account credited. And then this is where now we talk about your folio in your ledgers. The folio will indicate where the transaction is recorded. So the transaction is recorded in which book? Business cash payment journal. And then you write 20,000. Questions? None. Okay. So we're done with the first two accounts, capital, and then as well as drawings. Yes. Capital on the credit side. It's an owner's equity account, so it increases on the credit side. So which means that its opening balance will also be on the credit side. Sorted. Okay. Okay, moving forward. Now we go to business bank. Your business bank, every time we are making a payment, money is leaving our what? Business bank. Every time you receive money, which is business money, is going to your business bank. But you now have a journal that records all the money received and all the money paid. So this means that there will be total receipts. I'll explain why I'm writing it on the side, and there will be total payments. So your business cash book receipts indicate the total money that the business received in the bank account. So instead of recording the account individually in this, we have got a business journal account, business journal for that to record what? All the receipts. So this means that when we go to your business cash receipts over here, it does indicate that throughout this month, the business received 134,990. So this means that now you'll go to your, okay, sorry, by moving this side. So which means that now you'll go to your business bank and indicate that on the 30th, we had a total receipts, which is recorded in which book? Business cash receipts journal of 134,990. Then for total payments that the business make, you'll indicate that on the 30th, we made total payments, which are all recorded in the business cash payment journal. And the total of this was, is this the correct amount? 164,000. Of 164,006 rand. Once you are done recording this, it means that you have recorded the total money you received from your business bank account, the total money that you have paid, and this is all summarized because of what? The business cash book receipts journal and cash book payments journal, which then make it easier for you to track the total receipt and total payment. If we were still using the accounting equation, you are going to take all the records and put them on the debit side for all the receipts, put all the records for the payment on the credit side. So once this is done, we said that in our previous session, you are going to calculate which side is the bigger side. The bigger side becomes the totaling side, which you use it to put as a total, to say that this is the total money that we receive or this is the total money that we spend, depending on which one is the bigger side. So in this case, we are saying 140, 143,000 plus 134,990 gives us 277,990. So this is bigger than the payments. So this means that over here, we skip a line on the bigger side, come and put this as a total, 277,990, and we also put it this side, 277,990. The side that is the smallest, you are going to then have what we call balance carried down to balance this side. So now you're going to say 277,990 minus 164,006. This will then give you 113,984. The same amount that is the carrying balance is going to be the opening balance when we start the month of July. So this means that now you're going to have balance brought down for July being 113,984. So in our previous session, we said that you only balance capital account, assets account, and liabilities account. Your income and expense account, they are what? Totaled off. For example, over here, this is an expense account. So we just come and say what? The total is 20,000. This is a capital account. So we just come here and say what? 350,000. 350,000. And then this means that this side, there will be balance carried down of the same amount, 350,000. Then when we start the 1st of July, this means that it will move forward with a balance carried down of what? Balance brought down of 350,000. But the thing is, at a later stage, we need to close this account off to what? To the capital account. So when you close this off to the capital account, this means that the balance will not be exactly 350 anymore. So this means that when this is closed off, you do the opposite of this account. This account is supposed to be what? Debited. So this means that we credit it to close it off. And we debit what? Your capital account to transfer the amount to the capital account. So this means that this side on your capital account, it will come and say drawings. This side of your drawings account, it will come and say what? Capital account. And the total will be 20,000. 20,000. because we say drawings reduces the owner's claim in the business. So this is the correct principle that you're supposed to apply with your drawings account. Are we together on that part? So for your learning purpose, this is what I'm saying for now. We're not going to close off because we're not covering that part. If it is not there, we do not cover it for now. I'm going to explain a different method. So this means that this will still continue to be 350. I'll explain this when we get to the trial balance to say how do you apply this now when it comes to the trial balance. The reason I'm explaining this is so that you understand what is on your memorandum. On your memorandum, they went and debited your capital account. So we are done with the bank. Okay, 2 more minutes and then we take a break. Yes. You balance the capital account, all assets accounts, all liabilities account. Those are the ones that you balance. The income account and expense account, they are totaled off. You just put the total. Normally we close them off, but we're not going to cover that in this subject. So we're just going to total them off. Okay, equipment. So because we've got an account for equipment, this is what you're going to do now. You go and look at all of your journals. Is there any of the journals that have got an account called equipment or any records where you purchased equipment or either you sold or returned? That's what you do. So this means that if we go up, we can start with receipts. We didn't sell any equipment. Payments, we did not buy any equipment through cash. General journal, yes, we did buy equipment on credit. When we bought it, the value of equipment was how much? 9,500. So we bought it from who? Business creditor, Office Equip Limited. So the same double entry is going to be followed. Equipment is being what? Debited. The transaction occurred on which date? What is the date? 17th. And then we went and say equipment is being debited. What is the account that is now being credited? Business creditor. So you come and indicate we received equipment from business creditor, which is Office Equip Limited. And this transaction is recorded on which book? General Journal. And the total value of equipment is how much? 9,500. And this is the last transaction, right? That affects equipment. So this means that since this is an assets account, we're going to have to total it and balance it off. So this means that we're going to say 126,000 plus 9,500. So you're going to have 135,500, 135,500. This means that at the end of June on the 30th, this will have a balance carried down of how much? 135,500. Then on the 1st of July, we're going to start with a balance. Okay. balance brought down of 135,500. That will still be the value of our equipment when we start the following month. So currently it's 22 past, just 8 minutes leg stretch, and we're back. Okay, let's settle down and continue. So, just to do a quick recap. So, every time you do your ledgers, the first thing that you start with are the accounts that you have as your opening accounts, which will be listed on the information. You will write their opening balances, and then these are the same accounts that you will first look for transactions that have affected this account and record on these accounts. Those ones that they were not there as opening balances or have opening balances, those are the accounts that you're going to create at a later stage and record all the transaction that affects those accounts. So currently we are looking at all accounts that were given as what? Opening accounts, to say that these accounts, we have spent money on these accounts, or we do own this particular type of assets, or we owe these people, or these people owe us as opening balances. So all of those types of accounts, you start by recording them, work on them, and then lastly, you work on those that you do not have. So secondly, now we'll be looking at law library. Law library, which is your business books that you use to reference cases for your court cases, find your previous case proceedings that you're going to use for your current cases. So those are the books that you normally buy. So over here, we started with an opening balance of 425. So did we buy any law library books during this whole month of June? We never bought anything, right? Since we never bought anything, you just come and write this total back and say the total is still 425. This means that at the end of June, we have a balance carried down, which is still the same, 425,000. This also means that when we start the 1st of July, we're going to have balance brought down of 425,000. So if you remember our previous lesson, all assets, yes, I'm going to come to you, all assets, amount owed, amount owing, these are the amount that will continue with in the next coming financial period. That's why your assets, your liabilities, and capital are balanced off to indicate the amount that we're going to carry forward, the assets value that we're going to continue to use in the following financial year, the amount that the customer will continue to owe us in the coming financial period, or the amount that we're going to continue to owe our supplier. So that's why you're going to have these accounts being calculated where we're going to calculate the balances all the time. And then your income account, these are the accounts that we record throughout the financial period to indicate the total income made and the total expense incurred, so that at the end of the financial period, we can then be able to calculate the total profit that the business made. That profit that the business made is added to the capital account because it is the owner's claim on the business. This means that the owner's claim increased through the capital account. So in some cases, we can just refer to that account as what we call retained earnings instead of adding it to the capital account. Yes, you had a question? Carried down is the balancing one. Brought down is the one that you're carrying forward to the following month. So basically, it's the same thing. So we're just saying that we are trying to identify how much are we left with in terms of law library books. If you sold some or donated others, there will be a record this side that indicates the donation or the one that you sold. So now we need to calculate the value of those that are still remaining that you're going to carry forward. Because as a business, you're also insured. So this means that when insurance comes to pay, They will want to identify what value did you have of the assets remaining in your books so that we can pay you that value. If your assets have depreciated, we'll also show the depreciation of that in these accounts. But that's for advanced accounting. Okay, moving forward. Business client Julie Jube. We have got two records from these clients. One where he paid us 45 cents, and another transaction where he indicated that he's not going to what? Be able to pay us. The one that he paid us, we recorded it in the business cash receipts journal. So this account was actually credited when we record it in the business cash receipts journal, because your bank is the one debited, the business debtor is being what? Credited. So this means that you're gonna come this side. This occurred on which date again? 17. When I indicate on the 17, we received money in our business bank account. And this transaction is recorded in your business cash receipts journal. And the total amount that he received from him was how much? 17,100. So we're just repeating that double entry system by recording it on the ledger account. So this is what we call posting to ledger account. You take the information from your journal and post it directly to the client's account. And then on the same time, we went and said that there was an amount that was no longer receivable, where we went and debit credit losses, debit VAT input, and credit business client account, which is Julie June. So this account was still credited. So this means that this side, we're going to come on the same day. This also occurred on the same day, so we don't need to write the date again. Then we debited what? Credit losses and VAT account. This was all recorded in which book? General Journal. The total amount that we're no longer receiving from this client that we lost as credit losses was 20,900. So on this particular transaction over here, you follow the amount that is sitting on your business creditor account. If we are posting to the business creditor account, you use this amount. If we are posting to the equipment account, you use the amount that was on the equipment. You do not use the other one. So we are doing the business debtor, which is June, which the amount is no longer going to pay us is 20,900. So this is the one that we should. Are we together on that part? Sorry? Okay. So I'm saying that when you're general journal, you record a transaction according to the accounting equation. If the account is debited, you go to the debit side of that account. You write the name of the account that is credited. So now we are looking at business debtor to June. We have got credit losses that is no longer going to pay us, including the VAT amount, which were debited. His account was credited with 20,900. So we went to his credit account, to his account on the credit side, and then we write the name of the two accounts that were debited, which is credit losses and VAT. The amount that is written is the amount that is on the client's account. When we go to the VAT account, which is debited, we're gonna show what? 2,000. When you go to the credit loss account, we're gonna only show what? 18,000. So that's what I was explaining. Okay. So this means that now for Julie Job, his account is complete. So they've got 38,000 this side, 38,000 this side. So this account is closed off. We don't need to write balance brought down, balance carried down because it's zero. You only write balance brought down, carried down if there is going to be an amount. If everything balanced on both sides, we say the account is closed off. So now we move to debtor Salisno, who had an opening balance. We're going to come to Toby Taylor. So this customer, how much did we bill him? And on which day? Based on our records from journals. Salisno, we never billed him, right? But we do took money from his account, right? And transfer it to business bank. When we did that, we went and recorded a transaction to indicate that money was taken from his account. Do you still remember that? Debit, trust client, credit what? Business client. So the business client account is what? Credited. So this means that we need to go to his account. This is his account. We're going to come and indicate that on the last day of the month, which was the 30th of June, money was transferred from his what? Trust client account in bracket SS. This was recorded in which book? Transfer journal. The total amount we took from his account was how much? 45,000. So this means that this account we just total it off to close it off to indicate that both sides we have got 45,000. So this customer will no longer owe us. So you trace everywhere where there is a record affecting the account that you have opened, and you record the transaction and you use the date which the transaction occurred. Are we together? Okay, let's look at the VAT input. VAT input, we're going to follow transaction by order of dates, recording each and every transaction that occurred to say we have got VAT input that we're claiming because of this transaction according by date. So let's look how many VAT input. Let's kind of this one. I'm going to use the transaction. We've got one for the fourth, which we paid rents. So this means that here it's going to say the 4th of June. So which account? This account was debited, right? So what was the account credited? Business bank. This was recorded in which journal? Business cash book payments journal. And how much was that amount? It was 1,826. 826. Then we have another transaction. We purchased stationery. But this time when we purchased stationery, we purchased it on what? On credit. So this means that this occurred on which date? On the 10th. We are not taking transaction from the transaction themselves. We are following the order dates, but recording them in terms of how the VAT input account was affected. We are using your journals. It's just that now I'm using the what? The transaction that side instead of looking at the order. So we have got the 10th. Then the account credited was what? Business creditor. ABC stationers. So this was recorded in what? General journal. And the amount is how much? 1,650. And any other account that affected this VAT input after that? We go down. Okay, this one, you paid entertainment, you were charged input VAT, but you cannot claim it back. So we never recorded this. So you jump that. The one on the 17th, when a customer can no longer pays you, it means that also the VAT output that we're supposed to pay to SARS, we can no longer pay to SARS. Sorry, if we've already paid it to SARS, we have to claim it back. So this means that this also have the VAT input. So you're gonna see on the 17th, the reason we are having this VAT input is because of what? Which was the account credited. Remember, this was debited. We need to write the name of the account that was credited. And it was it Julie Jub? This was recorded in General Journal. Yes. Credited. Okay, for this one, what did we do again? We paid rent of 14,000. So when you pay rent of 14,000, you paid through cash, which means that through your business bank account. So the accounts affected, you have got rent, which is being debited, VAT input being debited, and the account credited, business bank. So since this is debited, you go and write the name of the account, credited, which is your business bank. So basically what we are saying over here is to say that we have got VAT input that we're going to claim, which was from a cash transaction which took place from our business bank account. We're going to send that supporting document that indicated that we made that payment to SARS so that we can be able to claim back that VAT. So how much was for this one was how much? JJ, how much? 726. Okay, I'm gonna look for another one, the computer one on the 17 again. We bought the computer, so I'm not gonna write the 17. I'm gonna add few more lines. On the 17th, the date is the same, so we don't have to write another date again. So this time around, how much, what was the accounts affected? We debited equipment, debited VAT input, credited. So you come and write business credit. And the business creditor was and this was recorded in General Journal. The amount is 1,425. Then after that, amount pay bank charges. So for bank charges, we debited bank charges, credited, debited VAT input, and credited what? Business bank. So this occurred on which day? 29. So it's gonna say business bank. This is recorded on which book? Business cash payment journal. And the total amount was 66. So when you look at this reference, if I go to all of your books, I need to see this transaction and this amount on your VAT input column. For each and every book, if I open based on the volume, I need to be seeing all of these amounts. And then that was the last one, right? So we total this off. How much is the total? With the opening balance, 35,000 plus 1,826 plus 1,650 plus 2,726 plus 1,425 plus 66. This is 42,600 42,693. So remember on the other part, they told us we need to close off the VAT account to what? To VAT control. Once you have this amount of 42,693, this is the amount now we can transfer to our VAT control account. In order to transfer this, it means that since this account is always debited, you credit this account so that you take this balance off from this account. By crediting this account, you're going to be crediting it with what? With the same total and debiting what? Your VAT control account. Remember, we said that your VAT input is always debited. So this means that also when it goes to your VAT control account, it needs to be on the debit side of your VAT control account. So this means that on this transaction that I mentioned, we're going to come back to it later on. This is the transaction occurring on the 30th. Once we have identified the total VAT input, to say that your total VAT input that is being credited it's 42,693, which is also going to be debited to your what? VAT control account. So this means that when we come to the VAT account itself, this side of your VAT input, you'll say on the 30th, there is what? VAT control account, which will then indicate that this is recorded in your what? General journal. The total amount is how much? 42,693. Meaning that now you can go to your VAT control account, which was debited, and indicate on the 30th of June, VAT input was transferred to this account, which is recorded on what? General journal. The total is 42,693. So that's how you prepare your VAT control account. So this means that we're going to have VAT input on the debit side, VAT output on the credit side of your VAT control account. After that, we're going to say which one is the bigger side. If the balance, if this side is the bigger side, it means that balance to be carried down will be on the credit side. If the debit side is the bigger side, so the balance brought forward will be on the debit side. If the balance is bigger on the credit side, it means that balance brought forward will be on the debit side. So this means that you will have VAT payable if it's on the credit side. If it's on this side, this is the bigger side, the balance will be on the debit side, indicating that you have got VAT what? Refundable from SARS. So this is how we determine VAT refundable and VAT payable. We use the control account. So this means that now you'll go and have to record the transaction on the VAT account. So I've already shown you so many transactions about the business. So now we're going to move to the ledger's accounts. You complete the rest of the other accounts. Okay, I think this is where we are now. Trust ledger accounts. So on the trust ledger account, we started with this opening balance. So you're going to go to your trust cash receipts to check if you ever received any future legal services money in this current month. So we actually did, and that was on which date? Was it the 5th? Or it was on the 10th. So you're going to indicate on the 10th of June, We received money, but the money we received was from which client? So this is how you will have recorded it if you're doing individual accounts. Or in the next coming lesson going forwards, these are what we're going to be doing. But because this is your trust cash receipts, you can just come and say what? Total receipts. When you indicate the total receipts, you'll indicate that this is coming from a trust cash receipts journal. The total money received is what you record on this account, which is 40,000. Then we went and said that at the end of the month, there was money that was transferred from Trust Bank to what? Business Bank. That transaction would have been recorded in your Trust Cash Payments Journal. But you do not have the Trust Cash Payment Journal. You were not required to prepare it, but it was going to be recorded in that journal. So this means that on this side of your Trust Bank account, you'll also need to record it, even though you are not required to prepare the Trust Cash Journal, to indicate that there was money that left what? Trust Bank. You say 30th of June, and then this side, you write Business Bank. This would have been recorded in your Trust Cash Payment Journal. And then the total amount, 113,000. So this is the total that was in our trust account. So this means that our trust account will be zero. No balance brought down or forward. And then I'm going to use this account of trust creditor Salisno. We were owing Salisno 55,000. So we took money from his account and paid over to what? And transferred it to the business account. When we did that, we went and performed a transfer what? Journal. When we perform a transfer journal, his account was what? Debited. We debited trust client account, Salis no, and then we credited business client. So since business client was credited, this side, what will you record? We indicate that on the 30th of June, money was transferred from his account to his business client account, which is for the same person, Salis no. This was recorded in which journal? Transfer journal. The total amount we transferred that he was owing us was how much? 45,000. Then the bigger side is which side? The credit side, because there are no other transactions. So this means that the smaller side will have what? Balance carried down. This means that when we start the 1st of July, this person will be owing him or holding on his behalf. How much? 5,000. Is it 5 or 10,000? 10,000, which is 55 minus 45. So this is the balance that will be left in Salisno account. So you guys will do the same thing for Toby Tyler, yes? So every time you're done recording transaction in the account, you check which side is the bigger side. The side that is the biggest, you use it as the total inside. You put it as a total, you add and you get the total. You put it on both sides under amounts. Then the side that is the smallest, you're going to have balance carried down. On the side that is the biggest, after the total, you're then going to have balance brought down. On all accounts that are balanced. So this is a liability account. We owe this client money. So this means that it will have to be balanced. Yes. Okay, I think that concludes everything about ledgers. You guys will complete the rest of the ledgers. So I'm not gonna stop the recording. I'm gonna explain now the what we call this. I'm going to explain the part of the trial balance. So a trial balance, it is made up from your ledgers account. So we're going to look at your ledgers account. We take all the totals from your ledgers account and we just list them. We list all the accounts and their balances on your trial balance. Your trial balance will have the debit side and will also have the credit side. All accounts that had a credit balance, the balance will be on the credit side. All the accounts that had a debit balance, the amount will be on the debit side. For all your income accounts, they will be on the what? Credit side. For all your expenses account, the total will be on the debit side. And then we go and split the accounts. When we split these accounts, we split them in the following way. You are then going to have the statement of financial position section, which you are going to then list your assets, capital, and liabilities account. This also includes drawings. Please also list your drawings under the statement of financial position. Then you're gonna then say nominal section. Under nominal section, you will then list your income and expense account. So just to show you what I'm explaining, these are the balances of our account. So over this one, when we listed this, instead of listing the drawings, so I'm going to show you because we did the drawings account differently. So the balance over here, it will say 350. And then here, we're then going to have drawings of 20,000. So this is how it's going to look like. Your drawings is debited, so the balance of the drawing will be sitting here, and your capital will be sitting at 350. When we prepare the statements of financial position, we're gonna say 350 minus 20,000 under equities to show that balance of 330. So all your assets balance are here. All your liabilities balance will be on this side, which is the credit side. So in the assessment, they will either give you list of accounts and say prepare trial balance, just general ledgers balance and say prepare this. So when you prepare this, you start with the statement of financial positions account, which is the assets, capital, drawings, and liabilities account. All your assets will be sitting on the debits. All your liabilities account, the amount will be sitting on the credits. Then you're gonna say nominal section. And the nominal section, you start with your fees account. The total will be sitting on the what? Credit side, because that's the side which the balance is. Then all your expenses account, they're on the debit side. Their balance is on the debit side. So you have them on the debit side. So just to close off, they say prepare the statement of comprehensive income. So the statement of comprehensive income, so you're gonna say total income, and then what accounts made up your total incomes? Or let me just say income first. In our business, we've got what? Fees. If you received interest, you will write what? Interest received. If you received rent income, you're gonna write what? Rent income received. After that, you'll write that what? Total income. And then you're gonna say expenses. In our case, we've got salaries and wages. I'm just gonna write all I remember. salaries and wages. We also have got rent expense. We also have got stationery. We also have bank charges. What other expense did we pay for? On your cash book payments, what were the expenses? Oh, we also have got credit losses, which is on the general journal. What other expense do you have? What other expense? Salaries and wages is there, rent expense is there, stationery is there, bank charges, uh, equipment is an asset expense. That's it. Okay, let's just quickly confirm. Entertainment, that was the last one. So we're gonna have entertainment. Then we're gonna say that this is your total expenses. After that, we'll then say net profit. Okay, for this, I'm gonna do this. That's for now. I just want to create columns. So now we can create our columns. So this means that this side, you will write your total fees, which is coming from this, your trial balance. They'll give you a trial balance and say, prepare the statement. So when you prepare the income statement from trial balance, you take the total of 913,600 as your fees amount. You list it here and say 913. If you're given one column, it's fine. You can use the one column and say 913,600. And the total income, you'll show this side that the total income is 913,600. If you're given one column, just show it under the same amount. Then for salaries or for expenses, we're gonna come and highlight all these expenses. Okay, this one work. Okay, my undo, it's have disappeared. Okay, we have it back. So it's fine, we'll leave it. So your rent expense, 68,174. Your salaries and wages, 525,000. Your stationary total balance from your ledgers, 57,000. Bank charges, 440. Credit losses, 18,174. entertainment 2,500. And then here, under your total expense, you put in your total expense in brackets. I don't know how much is the total expenses, but you will add all of this amount and put the amount over here. Then you're gonna say your total income minus total expense to get the what? Net profit. So this is how you prepare your income statement. Not complicated, right? Yes. No, here we do not have debit or credit. This can either all be written here in one column. So meaning that all this total, all this amount will be here. You add them to get the total of your total expense. You add all the incomes account to get the total income. So they can all be in one column. So you can either choose one column or two columns, but in the exam, they can either give you two columns or one column. The reason I'm showing two columns is in case in the exam they give you two columns, so that you don't get to be confused. Why do I have two columns? So basically here, this is the column where we just list the accounts. This side is the column where we calculate the totals. The total for the income, the total for the expense, and the net profit. Yes. So for your statement of financial position, which is the balance sheet statement, you are just grouping these accounts. Assets, you group them together. Equity, you group them together, which is your capital account only. And then you're going to have liability, you show it. But under equity, make sure that the net profit that you have here at the bottom, you also show it under equity, or you add it with your capital account so that your statement balance. If you do not add it, it will not balance. So please, for the statement of financial position, look at exercise 11 on your workbook. That will then be explaining the whole concept.